Hello there, welcome traders and analysts. My name is Ali Ash. In this video, we'll be doing some analysis on BTC and gold as well. So, I hope so you can see the stream in my screen. Let me just take a look at it. Yeah, it's showing on YouTube. I guess showing on Twitch as well. Okay, from now on, we'll try to just do all of this on the live streams. And in the start, it will be a short live stream, so 30 minutes or less than that, even. Okay, so we're good. So, in this, my idea is to first give you some analysis on the BTC and gold, and then we'll go on and hover on a topic which will be the part of this DMF concept and explain you what is DMF and how we'll be going through its syllabus. So let's get back to it. Yeah. So right now we have BTC chart on an hourly time frame. We have this Fibonacci here. Let me add the background. Okay. So first of all, if you're using Fibonacci, the way to use Fibonacci is to find the range analysis. So in the DMF, which is the dual market framework created by myself, in this framework, there is a topic on range analysis. Range analysis means to know and be aware of where the market is standing and what the market want to pursue. So second. I'm going for a longer time frame, so let's take this from here. Yeah. So we'll be using this low and this high, and right now you can see that and let me just remove this arc angle as well because it's no use right now. Lastly, previously we saw this double bottom here with this arc angle. So to identify the neckline, I've made this arc. So you'll be using this Fibonacci to find the range of your market. So from 10th of March, we are here on 5th of April. We are hovering around the central zone. We saw this resistance lately, and this is our volume fill up area. This is what, so on any liquidity swap, we see so what is liquidity swap? Liquidity swap is a wick which shows that the body is closing way beneath the body, way beneath the levels of the body. So this is our liquidity swap, and on liquidity swap we mention this as a volume fill up. So the market has to come here someday before it can make a liquidity sweep just like this. It has to fill this up, and then it will go for a liquidity swap. So lastly we had this liquidity sweep, and then I guess this one was one of the liquidity swap here, and then we have this another one right here. So we need this to be ended somewhere here on the bottom. So this is our volume fill up area, and right now we are lurking around this central zone. So this grayish area, let me just lock it up because it will just okay. So this grayish area is the central zone. You can see that the 50% is grayish area to up till 61% and 38% is the central area. So market is using this as the support and trying to go over this resistance. So if it's able to penetrate this resistance, pretty sure that and we are sure that it can go and touch this resistance as well. So this is our insider resistance. We will call it as the insider resistance. This is another minor resistance. You can just say a breaker block. So this is our breaker block. This is the volume fill up. This is the insider resistance. This is the curve. We are going banded curve, and this is the banded support curve. So with this, you can see the volume contraction, volume expansion. Right now, we are in the volume expansion. So we can see a W here. Let me just pull up my pen here so I can show you in detail. Uh, okay, here we go. So we are seeing, my bad. So we are seeing this rat trap area. This rat trap area is always used to build inside liquidity, and once it's done with it, it will expand itself to go over this wick to fill the volume. So this is what we are seeing right now, and if you get a W here, so this is one W, then we got an M, then we are seeing another W. So yeah, and if you're using Fibonacci for range analysis, you have to use these settings. So you can just copy my settings as well. So here we have the 0, then we have 0.25, 0.38, 0.5, 0.61, 0.75, 1. That's all. And you can add the background. And if you are going for, if you see the resistance here, you can just reverse this up. You can add the price levels as well. So yeah, this is all for the Fibonacci. So you'll use Fibonacci for range analysis, and it works really good. So I heavily recommend you that you use this. I'd highly recommend you to use Fibonacci for your range analysis, and it's one of the most important concepts in DMF. DMF is the dual market framework, so I believe that the market is all about duality. So what has to come down will has to go up itself. So the market creates structure in the middle of it to build the insider liquidity. With those liquidities, with those accumulations, we see the distribution. So this is the manipulation, this is the accumulation, and then we'll see the distribution. So it's AMD concept here. So yeah, here we are seeing a rat trap, and then we'll see a move on the upside. So this is for the BTC, and let's go on the gold. So with gold, we are seeing. So today market is closed. So tomorrow I see that this is an ellipse in creation. So the ellipse is in process. Let me just go on a lower time frame here, and let's suppose this is an ellipse here, and we will do an SR interchange. So this is our first reversal. Let me remove these first. This is our first reversal area for the ellipse. Then we'll see a breakdown. So from this demand, we'll see a breakdown to 2,945, and we'll add up a central zone area as well. So with DMF, which is dual market framework, we also use central zone as well. So we'll be using central zone here for this total demand, and here we go. This is our central zone. So here is the first stoppage. Then if you're doing trading here, so this is the first TP, then this is the second TP. You can do this if you are doing on a high leverage, high open margins. Then you have to use multiple Fibonacci levels as well. So these will all be the TPs for this, and this is the order block. Okay, so we are good with this gold analysis as well, and let's come back to the topic. So I'm taking a break of 3 to 4 minutes, and we'll be back with the topic as well. Okay, so let's get back to topic. So with the phase one and phase DMF phase one, we'll be talking about and this very important topic, and each and every trader has to go through this concept before they start learning this DMF course. So the course will be online, it will be free, it will be live, and we will backtest every single strategy, we will backtest every single concept as well. So with FTZ fair trading concept, my idea is about to give traders insight what they're doing and what they should know about the markets before they hop on with the trades. So with FTC concept, it's a fair trading concept. FTC about understanding the do's and don'ts of trading, managing risk, and approaching the market with a strategic mindset. Many retail traders liquidate their accounts within 90 days due to poor risk management, over trading, and emotional decision making. So due to greed and FOMO, and I've been in the same place. I have made the trades which are based on my emotions, and I've seen a backlash. I've seen my accounts being liquidated. I've seen my funded accounts being being cancelled and being suspended. So from all of those experiences, I've created this concept, and this is to understand how you have to use this concept in trading to become a successful trader. So first of all, you need to know these principles. So the core trading principle, starting with the first one, is identify yourself as a trader. So what trader are you? So are you a scalper? Are you a day trader? Or are you a swing trader? Or are you a long-term investor? So you need to understand, and based on that, we will formulate a strategy that will help you, not just strategy but the mindset as well, that will help you eventually to become successful at what you're doing. So a day trader is one who places a trade for like 30 minutes or 1 hour, or even for a few hours, to and comes into the the US Open and goes with the US close. So that's a day trader. A scalper is one who just finds the opportunities, hop in and hop out. So just entry and exit within the profit levels, and this is how a scalper does. A swing trader is one who trades for more than a day, and an investor goes for a week or even a month. So based on that, we will find a strategy. So based on that, you will take my strategies and my concepts and use it for yourself. So some of the strategies are good for scalper, some of the concepts are good for day trader, and some are good for investor and swing trader as well. So you have to see what works for you, you have to see what's not working for you, and you have to place your trade accordingly. So coming back to the second topic, second trading principle, which is the leverage and margin. So how much leverage you should take? So with leverage, it's like so I see the leverage as a heist. So with more leverage means more blazing guns, more risk of knowing what you're doing. So with margins, your trades come into the records of the pools, and I don't want to go into topics because yes, if you are asking me this, that do banks hunt for stop losses, I would say yes, they do. They have data analysts, they have people sitting at their places and seeing your positions. So with those positions, you will be at a risk of showing your trades. And obviously, if you are going with the blazing guns, you know what you're doing. And if you don't know what you're doing, you'll see what's coming next for you. So with leverage and margin, you have to keep it very less to become discreet in the marketplace. So with higher leverages comes with lower time frames. So this concept must be in your mind. So if you are taking 300x leverage, if you're taking 200x leverage, you should be going just for ticks or just a minute of trade, or maximum to 5 to 10 minutes. If you're trading with 125x, I recommend just going for 15 minutes or less than that. If you're going for 75x, 50x, then you should go for 30 minutes at most. And if you're going for 30x or 50x, then you should have a few hours of trade. If you're going with 25-20x, you should have, you can call it a day trade or swing trade. And if you're going as an investor, your margin should be just 5x or 10x. So based on that, you will assess your risk and reward ratio as well. So that's the second principle. Okay, so let me catch my breath here. Thirdly, the third principle is liquidity and market awareness. So with this, let me show you with the chart. So here with the BTC chart, what actually I am doing is I'm understanding the market structure and being aware of where the market actually is. So right now the market is actually on the central zone. So I know that this is the no trade area. So I'd be putting my trade here. So so this will be my long. So here just, so let's suppose the market is here. This will be my long. And this will be my short. So with this, you will be able to understand the market structure quite well. So, and with each area, we have one of the risk and reward, which is double than this one. So here we have this much of risk and reward, and here we have this much. So one side will be dominant than the other side. So in this price action, the buyers are more dominant than the seller ones. So here the sellers risk and reward is this much, and with buyers the risk and reward is this much. So you can see the market structure, you can be aware of this quite well when you're trading. So that's the third principle. The third principle is about understanding the market structure and insider liquidities. Now comes to the fourth principle, which is the risk and reward ratio. So with high leverages, you have to keep your risk and reward quite low. So with high leverages, your risk and reward should be 1:2, and with and with lower leverages, your risk and reward can go up to 1:10 and even 1:30. I've seen 1:30 as well. So that's how you're going to do it. So if you're thinking that with higher leverage and you are on the order block, you are on the support and you are aware of the market and you can place a high risk trade, still I would not recommend you doing that. I have done this in the past and I've seen the worst of it. So this example, if you are investing $100 with a 1:2 risk and reward, your entry price would be $100. Let's suppose the stock is in $100. Your stop loss will be the 10% of your trade. Your take profit will be 20%. So that's 1:2 risk and reward. And the time frame should be not more than 30 minutes. So it will be just 15, 30 minutes at most. So you lose $10 and you win $20. So that's how 1:2, that's how the risk and reward goes. So this is the highest analogy trading against the banks. So if you use 50x leverage, you're storming the bank with machine guns. So with 50x leverage, you have high margin, you have high capital. You're showing the bank you're coming with guns blazing, and they will go against you, and that's a massive risk. So until unless you are at the very bottom of the support, you know the inside liquidity, you know the price action, you know everything about the market, then and unless you can trade with this leverage. Without that, you are just going to liquidate your account. I'm saying that twice, thrice, even twice. Don't do that. I've been there, I've done that, and I know how things work. Now comes how liquidity works and why most retail traders get liquidated. So liquidity is the market's ability to fill orders without significant price movement. Market makers, institutions, and HFT manipulate liquidity to trigger stop losses and sweep retail positions. Most retail traders lose within the 90 days because they over leverage and get liquidated by the market movements. That's the first. The second is fail to recognize the institutional liquidity sweeps. The third is chase trades impulsively without a plan. Fourth, enter positions without understanding optimal trade zones. So let's come back to the chart again. So here we have this. Okay, so let's suppose you didn't know this. Let unlock this first. Okay, so you didn't know this, you didn't know the levels, and let's suppose you started trading here and you put a long position here because you see a large wick here. So this will be your stop loss, and this will be profit margin. And so, and if you're trading for more than like more than few hours, what you're seeing that you're getting stop loss here. So this is what I believe that. And let's suppose you are trading here and you're going for long hours and you haven't exited the position yet. So again, you're getting stop loss here. Let's suppose you are trading here. This will be your stop loss. And if you're not exiting here, again, you'll be stop loss here. And here you can see that you will almost stop loss here and you will surely stop loss here as well. So this is what I want to show you with this. So with fair trading concept, you know that when to end your trade, how much leverage you have to put in, and where is the liquidity present, and where is the optimal trading zone. So the optimal trading zone will be here, but not here, but not here, because this is central zone. And to know the optimal trading zone, you have to use range analysis, which comes with the DMF concept. So this is the central zone. You should be trading here. You should be taking the position here. You can take the position here. So if you're taking the trading position here, you will be stopped out right here. And if you're shorting here, let's suppose you're shorting here, see, you will be stopped out. If you are taking long here, maybe here on the central zone, you will be stopped out. So this is the no trading zone. This is also no trading zone, but still it can work for you. But this is the optimal trading zone. This is the optimal trading zone. This is the optimal trading zone. This is surely the optimal trading zone. This is, of course, the optimal trading zone. So whenever the market comes here, so let's suppose this is the resistance and market came here, this is the perfect trading zone. So with range analysis, you'll be able to find the exact trading zones that you want to trade with, and this will help you to retain your stop losses. It will help you to go in all in profit. So that's it for this. Let's come back to the topic again. So coming back to the topic, FTC, and are we done with this? Yeah. Okay. Key concept to avoid liquidation: risk only 1 to 2% per trade. So your balance out of your total capital, total balance, you should only trade up to 2% per trade. If you are if you're very if you know how the market is working, you know the inside liquidities, you have optimal trading area, trading level, then you can trade up to 5%. But I would only say that only risk 1 to 2% per trade. Understand the market structure, then backtest your strategy. So if you are just gambling on any strategy or any indicator, that would not be great and can lead to liquidation as well. So backtest your strategies, avoid over trading, then use multiple time frames for confirmations, and trade only in optimal market conditions. So do not trade when it's a news event. Do not trade when the volatility is high. So how do you know the volatility is high? By using the wicks. So if the wick is big enough, you know that there's liquidity in place. So, and the another topic is building a sustainable trading plan. So never invest more than 5 to 10% of your savings in day trading. Low margins, divided capital approach. So you have to buy the positions in divided. So we call it layering. So you buy first position at 30%, then you buy 20%, then you buy 30%, then last you buy 20%. So you have to divide your positions into four segments, and we call it as layering. Then plan every trade and adapt and learn continuously. That's how you will build a sustainable trading plan. So there are trading rules, and we'll go over this topic in the another live stream. So I hope this helps in any way, and we are good to go here. So if you need this document, I will be leaving this document in the description or the pinned comment, so you can look at that. Thank you so much for watching this video. We'll be back with another video, with another live stream, and discussing another course topic as well. Have a good day.